Hello everyone, welcome back to another chapter of Debt K Fund Day. In the previous chapters, we have covered on basic of debt and how to select a debt fund, in which we have covered this risk appetite and the type of risk which are involved in debt funds. But how do we define how risky a fund is? That is where SEBI in 2015 introduced Riskometer. Riskometer is a simple method to define what is the risk of a fund. Each fund, based on its portfolio, monthly basis get assigned risk. There are certain parameters for which SEBI asks mutual fund to define their risk on. But how to read this riskometers? So riskometers are defined on 6 parameters, from low to very high. So low means the portfolio has very low risk. Then it moves towards low to moderate, moderate, moderately high, high, and very high. For example, if you see at the screen, currently the riskometer mentioned there, you'll be able to see that the arrow is low to moderate. It means that particular fund has a risk of low to moderate. Where will you find this riskometer? The answer to do is in everywhere, wherever the AMC talks about the fund, the riskometer will be there. Either at the end of an advertisement or on banners, on product presentation, on their websites, on fact sheet, everywhere where the fund is mentioned, you'll be able to find the riskometer, from which you'll be able to understand that what is the risk of that particular fund. Why are we talking about riskometers and why SEBI has made it mandatory for the mutual funds to show the riskometer at the end of every product presentations or every product material? It's because it defines the risk of the portfolio. To make it easy for the investors to understand that what is the risk of the portfolio before investing in it, it's mandatory to show the riskometers. It will help you, one, to understand what's the risk of the portfolio. How it's going to help you? It's that way. For example, for your contingency, you want to keep certain amount in your liquid fund. Now, since it's your contingency fund, you don't want to take high risk, and that's why you kept it in the liquid fund. Now, when you look at the risk of a particular portfolio, you'll be able to understand that which fund has how much risk assigned to it. Some liquid funds are a little higher risky because they invest in low quality papers, and some liquid funds are low risky because they invest in good quality papers. So that is how where you can differentiate and understand that what is the risk of the portfolio. Secondly, it will give you a historical understanding of the portfolio. Not only today's or month and portfolio based riskometer, but you can look at the historical riskometers and understand that how that fund has done in the past, what risk it has taken, and whether it is consistency in the risk it takes. That will help you take a decision better. So you can compare the categories fund into it. Third is to compare the different funds. For example, you want to invest in a particular category, and there's a fund A of that category giving you 10% return, and the fund B giving you 9% return. On what basis will you select which fund to invest in? Because returns are historical and they are not indication of what that fund will give you in future. Riskometer will help you in that. You can see how much risk fund A has taken to generate a 10% return and how much risk fund B has taken to generate a 9% return. This is how it will help you to compare different funds of the same category. Also, you have your own risk appetite. You understand how much risk you want to take. To match it with the fund, just category risk is not important. It's very important to understand what is the fund risk, and this is how it will help you to match your risk appetite with the fund risk profile. But how this risk is defined in this riskometer? How are we saying that a fund is a low risk or fund is a high risk in that? So based on the parameters, these funds are assigned risk. Each parameter is assigned a score, and at the end, this score are simply aggregated to understand the overall risk of the portfolio. Both equity and debt funds are evaluated on different parameters. Equity funds are evaluated on 3 parameters, that is market capitalization, volatility, and impact cost. So market capitalization means whether it's a large cap, how much is the large cap in it, how much is the small cap in it, how much is the mid cap in it, because small caps are generally higher risk and the large cap are little low risk. On that basis, the scores are assigned to it. And at the end of every parameters are evolved, the scores are aggregated to define the risk of the portfolio. Second parameter on which basis the risk is assigned is volatility. Volatility is assigned on the daily changes of for the last 2 years to see how volatile the fund is. Third parameter is impact cost. Impact cost is considered as a measure of liquidity there. Impact cost is the execution cost of the entire transaction that happens. On these parameters, all the equity funds are evaluated and the end risk score is defined, and that risk score gives them a risk assigned to it based on the riskometers parameter. Similarly, on debt funds, they're evaluated on 3 parameters: credit risk, interest rate risk, and liquidity risk. One is a credit risk. What kind of papers are they holding? What quality of papers are they holding? Interest rate risk, which is dependent on the Macaulay duration of the fund. The higher the Macaulay duration, higher is the interest rate risk, and so is the higher will be the risk, moving them towards the higher risk side. Liquidity risk, how liquid is the portfolio? So if some events happen, how easily one can liquidate the portfolio is the liquidity risk there. On these three parameters, the scores are assigned and again evaluated to define the risk of the fund. This is how a risk of a fund is defined. And it's very important that you look at the Riskometer before investing in it so that you understand the portfolio. And not just the current month Riskometer, but the previous month's Riskometer also to understand the history of the portfolios. Thank you and stay tuned for more chapters.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.